Good morning and welcome back to Almus Market Mornings, your daily dose of global financial updates. Fed minutes failed to move the markets, and it's clear that there is somewhat of a divergent thinking between the Fed and what the market is expecting. Amidst the tightening and a cautious situation, reports are surfacing on a strong rally in equities. For example, a Bank of America strategist has recently commented that the S&P 500 will hit a record 5,000 levels next year. JK, with such expectations around, doesn't these expectations of easing in itself fuel consumption and might add to the inflation? What are your thoughts?
Yes, I think the stock markets are currently rallying, not just based on the inflation easing, but also abundant liquidity. And as we know, a lot of issuances will be coming from the government, and that will support that will actually suck out a lot of liquidity along with the QT that is ongoing from Fed. So eventually, stock markets will find it difficult to price the equities much more than this when the liquidity is less, and also when the growth itself is facing some challenges. That is something we'll have to wait and see. 5,000 is a number, but it can be hit or it may not be hit, depends on how the economy evolves and also how the liquidity situation evolves. But coming back to the markets yesterday, in the absence of any major numbers from the economy, we had the Fed minutes that the market was looking up to give some clues on what the thinking is on the monetary policy going forward. And it did not throw anything new other than what they said post-Fed meeting, and that actually they remain cautious about either over-tightening or, assuming that they have won over the inflation. So it's quite a neutral statement that eventually has come out from the minutes. But as you said, the entire Fed members disagree with the market pricing. And it is apparent from the statement that all participants judged that it would be appropriate for policy to remain restrictive for some time until inflation is clearly moving down sustainably. And this is quite contrary to what the market is expecting, already discounting a rate cut in May. In fact, similar sentiments are expressed by the BOE officials also yesterday. They're saying that the market is putting too much weight on the current data releases, and the fact that we have seen inflation come down quite rapidly in the recent does not mean that we have won over the inflation. Policy stance is likely to warrant higher for an extended period of time. Lagarde was also very clear. She emphasized that we will remain attentive to ensure that our policy rates will be set at sufficiently restrictive level for as long as necessary. She said we will need 2 years to get inflation down from current 2.9 to 2%, and that the overall inflation is likely to accelerate once again. So the continuous efforts from the policymakers to push back against the market's expectation of early rate cut is very, very apparent. In the meantime, we did have some news on the economy, minor data, that's existing home sales, but it showed a drop to 13-year low in October, as the highest mortgage rates in 2 decades is biting into the housing market, and the overall housing market is still showing a slump in the US. Also, data showed that Britain borrowed less than predicted for its budget, and data showed that the Finance Minister Hunt is probably expected to announce some pre-election tax cuts as well. So then the markets are actually been very cautious on taking it too far from these levels. In fact, reaction to NVIDIA was better than expected results, particularly on the revenue side, has not pushed it much higher. We did have market close on the negative, but not a very big negative. This is quite reasonable considering the big rally that we have seen. recently, and probably market waits for more clues on the economy and also the monetary policy hints from the Fed, who will be meeting next in December. The Fed themselves will have another set of inflation and jobs numbers before they take a view on what the monetary policy is going to be going forward. Yields were in a very narrow range yesterday. The important thing is they are trading at the lows. The market is still assuming that data going forward will be supportive of lower yields. As I mentioned yesterday, 4.30 on 10-year yield is going to be a very big level. But I'm skeptical that yield goes much lower from here, considering the huge supply that is going to come still from the government, and also the QT that is ongoing as well. I think, go into some sort of a lull period in the next 2-3 days as traders head into Thanksgiving holiday and perhaps take a long weekend off, which means that they will be away for almost 4 days from the market, starting from tomorrow. On the currencies, dollar did hit new low yesterday at below 103.20, and since then it has seen a small bounce. That's again reasonable, given that we had seen big moves in the dollar index in the last 10 days. Chinese Yuan is continuing to outperform the other currencies, and that's actually par for the course, because that was quite an underperformer for several months. And the proposal by Chinese regulators to support 50 private and state-owned developers for refinancing is doing the rounds, and that probably is an additional support that they're giving to the economy, which may be behind the Chinese Yuan improvement. As I said yesterday, there are some green shoots in the economy which the investors are taking note of, and most importantly, the yield narrowing between US and China is also helping the yuan to improve. But no such reversal has been seen in the USD INR, which traded at new closing low at 83.3550 yesterday, but nothing big, just marginally higher. And important feature is that demand is still far outstripping the supply, and once again requiring the central bank to supply the dollars, and that has taken care of a lot of demand in the recent times. So it's time is ripe for rupee to show some strength, because we have seen a lot of demand being met at these highs, and many of the negative factors for the rupee have turned around, including the Chinese Yuan, which was very weak earlier. RER must have now gone closer to 101 from 105 that we had seen earlier. So any large supply hitting the market, if not absorbed by RBI, could lead to rupee strengthening. But I may be speaking a bit too early. We have not seen any evidence of it, but we just look out for it. That's the outlook. And finally, there's been some talk of a 5-day truce in the Israeli-Hamas war, but market has not reacted, as the war is set to continue actually in parts of Gaza, and Israeli Prime Minister has maintained that we will not stop fighting until we bring the hostages home, destroy Hamas, and ensure that there is no more threat from Gaza to Israel. So no sign of actual war ending. It's going to be a truce just for exchange of hostages, and also to ensure supply of necessities for the people who are suffering. Thank you. Look forward to dull period for trading for the next 2-3 days. Let's see if rupee throws up some surprises. Thank you.
Thank you, JK. And Fed minutes, there was nothing new, but the theme is that the Fed remains cautious on both over tightening or even claiming a win over inflation. So basically, a higher for longer theme was reiterated, which market is disregarding. Even on the ECB front, what the ECB chief Lagarde spoke about was she was also a proponent of the higher for longer theme, while being watchful for any resurgence in inflation. On the UK front, of course, there is some tax cuts being expected ahead of the elections. and it will be a lull period from tomorrow as traders in the Western markets go for the Thanksgiving holiday. Chinese yuan has continued to outperform as more stimulus measures is expected for the real estate sector, and USD INR remained marginally higher yesterday, but no new trigger as such. That's it from us today. Thanks for listening. Tune in tomorrow for the latest in the financial